In Solid Footing Chapters 7 and 8, we will study adjusting journal entries. Adjusting journal entries are a necessary part of accrual basis accounting. Recall that GAAP requires companies to use accrual basis accounting. Adjusting journal entries help us record revenues in the period earned and expenses in the period incurred, even if cash is not involved. Adjusting journal entries are recorded only at the end of the period, just before the financial statements are prepared. In the journal, as transactions take place, we prepare our regular journal entries. As we conclude the accounting period, we update account balances with necessary adjustments. These are our adjusting journal entries. After adjustments have been made, we are ready to prepare our financial statements. After the income statement has been prepared, we prepare our closing entries. With our post-closing trial balance in place, we're ready to begin the next accounting period. We begin our study of adjusting journal entries with property, plant, and equipment. This introduces us to two new accounts: depreciation expense, an income statement account, and accumulated depreciation, a balance sheet account. Depreciation is a terminology to describe the process of allocating the cost of property, plant, and equipment to the accounting periods in which the assets are used. The expense recorded each period reflects the usage of an asset to earn revenues. We are accounting for the asset's decline in value as it is used. Imagine that UPS buys a delivery truck. We know we have an asset because that delivery truck will provide benefit over many future accounting periods. We will record that truck at its cost. As it is used up over, say, 5 years, we will depreciate the truck and record its decline in value until it is ultimately used up. The manner in which we will do this is called the straight line method. The straight line method calculates depreciation expense by taking the cost of the asset and dividing it by its useful life measured in terms of years. For example, let's assume that UPS delivery truck cost $100,000 and that we could use it for 5 years. Our annual depreciation expense would be the $100,000 cost divided by the 5 useful years, resulting in $20,000 of depreciation each year. The journal entry to record the depreciation is a debit to our depreciation expense, which reflects the decline in value for that year's period of time. The credit is to our balance sheet account, accumulated depreciation. Accumulated depreciation is a contra asset account. Contra means opposite the normal balance of an account. We have the asset, which we record on the books at cost. We will not change that value as we depreciate it. Instead, we will record the decline in value in this contra account called accumulated depreciation. Notice that the normal balance of accumulated depreciation is a credit balance. For each depreciable asset recorded at cost, we will have an accumulated depreciation account where we total up each year's depreciation expense. Year 1, we will record the $20,000 of depreciation expense. Recall our journal entry is debit to depreciation expense and credit to accumulated depreciation. We recall from Solid Footing Chapter 5 that the expense account will be closed out and we will start fresh each year. The accumulated depreciation account, however, is a balance sheet account and it is permanent. We will continue to accumulate the depreciation each year that it is recorded. Notice that after 3 years' time, we will have accumulated $60,000 of depreciation. The asset's net value after year 3 is $40,000. That is our $100,000 of cost minus the accumulated depreciation. Notice how things play out over the 5 years. Our asset, our property, plant, and equipment, is recorded on the books at cost. And notice that doesn't change. The cost remains constant each of the years that we own it. Our accumulated depreciation, however, our contra account, notice grows by the $20,000 that's recorded each year. 20 to 40 to 60 to 80, and ultimately at the end of the 5th year, 100. As the accumulated depreciation increases, notice that the net value, which will be the amount reported on the balance sheet, falls from 100 to 80 to 60 to 40 to 20, and then ultimately at the end of the asset's useful life to a value of 0. We next turn to prepaid assets. Recall the definition of an asset. Any resource the company controls that will provide future benefit, that is, benefit beyond the current accounting period. The cost of assets acquired in one period will be expensed in a future period. Examples include prepaid rent, prepaid insurance, and supplies. As time passes, the asset is used up and an expense must be recorded. Let's examine an example. Assume on January 1st, ABC Company pays $12,000 rent for 12 months. On January 1st, record an asset. We will call that asset prepaid rent. The credit is to cash. The reason we are recording an asset is that on January 1st, when we make this payment, we have a benefit that will extend beyond January into February, March, April, May, June, July, August, September, October, November, December. At this point in time when payment is made, we have 12 months of future benefit. Now let's assume time passes and we are at January 31st. How much future benefit remains? We have used up 1 month and only 11 months remain. Recall, however, that on January 1st we recorded an asset of $12,000. That represented 12 months. On January 31st, however, we have only 11 months that remain, and we therefore should have an asset value of only $11,000. In order to move from the 12,000 to the 11, we need to record a reduction in the account balance, and that is our adjusting journal entry. We will record a credit to prepaid rent, and to account for the use of that asset, we will record rent expense. The rent expense represents the 1 month time that we have used up. Let's examine another example. Supplies. If a company pays $1,000 for cleaning supplies to be used over a period of months, we have a future benefit. We will record the supplies with a debit, and we'll credit the cash we used to acquire them. As time passes, let's assume we are now at the end of the accounting period and the supplies on hand are only $700. What is the required adjusting journal entry? We need to recall that on January 1st we bought 1,000 of supplies and debited that to our supplies account. On January 31st, if only $700 remain, the balance we want to report in our supplies account is $700. It must be the case that we have used up $300. and this is the adjustment that is required to the account. We will debit an expense, and we will credit our supplies asset account to reflect the usage of those supplies. Notice that the adjusting journal entry to supplies is not 700. To record 700 is a common mistake. 700 indeed is the amount of supplies that remain and the desired ending balance in the account. But to record 700 would ignore the fact that we began the period with 1,000. We have not generated 700 in new supplies. In fact, we have used up 300. Whether supplies or prepaid rent, in all cases, the adjusting journal entry for a prepaid asset will include a debit to an expense and a credit to an asset, or in the case of depreciation, a contra asset. We now move from the asset side of the balance sheet to the liability side. Accrued liabilities exist when a company has incurred an expense but hasn't yet paid cash for it. Examples include interest, wages, and rent. Generally accepted accounting principles require that we recognize expenses in the same period as the revenues they help to generate. This is the matching principle. Accrued liabilities will always include a debit to an expense and credit to a liability account. Let's look at an example. Assume that on January 31st, ABC Company owes employees for $800 of work performed during the month. ABC will pay the wages on its next pay date, which falls on February 3rd. Even though ABC will not pay the cash until February, it must record the cost of wages as an expense in January. Imagine that we have January, February. January is when the work was performed and the cost incurred. We will establish that liability at the end of the period, even though the cash won't be paid until a later period. The adjusting journal entry at the end of the month establishes the liability, that's a credit to our payable, and records the cost of employing for the month in the wage expense account. This matches the employee cost against the revenues they helped generate during the month of January. When the wages are paid on February 3rd, we will record the cash outlay with a credit. The debit will be to our wages payable account. Notice it is not to an expense account because the expense was already recorded in January. At the end of January, we had established an $800 wage payable. Now, when cash payment is made, we reduce the payable to show that we owe nothing to the employees. The expense falls in January when the services were provided by our employees. In summary, with an accrued liability, we have one period where the cost is incurred. That is when we will record the expense, even though the cash is not paid until the next period. In our prior example, our employees worked for us during the month of January. We owed them that liability as of the end of the month. We recorded our payable with a credit and recognized that cost as an expense with a debit. That is our adjusting journal entry.